So a couple years ago when I worked in the bank, we would have customers come in, do a refinance, and we'd have them bring in pay stubs and get the loan together right there. So they're face to face with us. And the one I remember the most is husband and wife comes in, they bring in all the documentation, I input the loan application, run the credit. And okay, so you have this mortgage, you have this car loan, this credit card, and do you still owe this $600 a month child support? And the wife is like, what child support? And the husband, they've been married a long time, had a child out of wedlock and was making child support payments, but forgot to disclose it to his wife. So
Forgot
that
to
was the
tell
end.
about the child or about the payments or both?
Both. So that was the end of the application process.
This is the Real Estate Reckoning podcast. Welcome to the Real Estate Reckoning podcast. I'm Cara Amir, joined by my podcast partner in crime, the PhD of all things real estate, Mr. Scott Kramer. And today we are joined by a very special guest, mortgage expert, Robert Towers from E Mortgage Capital. Robert is a senior loan officer with over 30 years of experience, and he's based out of beautiful Newport Beach, California. Welcome, Robert.
Pleasure. Thank you.
So today we are talking about one of the number one things that creates stress in a real estate transaction. It's not enough just to find the home and negotiate an offer on it. It's when you have to get a mortgage on it. And so we're talking about how to avoid a mortgage reckoning today.
So Robert, as a seasoned professional, you've seen every mistake, every meltdown, and every preventable disaster. Expand on that a little bit.
No two deals are the same. Every buyer, every transaction has something. I like to consider myself as a tour guide. You could go to Tokyo and visit it on your own. I would rather go with a seasoned expert that's been there and can guide you from point A to point B as painless as possible. There's so many things that could go wrong. It's so important to be transparent with your team and also to have an experienced agent and escrow and title and the whole team working on the same page to close your transaction successfully and quickly.
So let's define what we mean by a mortgage reckoning. Let's go over the top 3 actions that instantly jeopardize your mortgage approval. Why don't you expand on that for us?
So the 3 parts of a mortgage are credit, income, and down. There's a lot of things that could happen with the credit. There could be a debt that doesn't show up on your credit report that shows up on the bank statements. There could be a misunderstanding on the income where you think you're getting paid salary and you're actually getting paid hourly, or the down payment could have been dropped into the account last week and customers are like, oh, what's the big deal? I have the money. There's a lot of rules that we have to follow in order for the loan to be sellable or transferable to an investor. So we have to unfortunately know what the guidelines are ahead of time so that we keep everyone within guidelines and closing successfully without any last minute scrambling. Once an underwriter sees something, they can't unsee it. So it's important to have all the facts on the table so that we can present the cleanest file to the underwriter possible.
So let's talk about new debt or, taking on new debt or debt that, buyers conveniently forgot about. What are some things buyers shouldn't do when it comes to taking on new debt when applying for a loan?
So different loans have different guidelines as far as debt to income ratio. Customers might think that they're okay. I can manage this new payment. I had a customer that was doing a refinance, and just as we were closing, they went out and got an expensive lease for their wife. We get notified if credit is pulled, and that almost blew up the transaction. So it's important. Had another customer that they were going to close in a few days, in a week, and they wanted to get ahead of everything, and they went Home Depot, got a refrigerator, went Macy's, got some furniture. All those inquiries popped up, and we had to address it. So it's so important to be transparent with your loan originator, and if possible, don't do anything until the transaction is closed.
So don't go and lease a new car, right? People think, well, I'm just leasing, I'm not buying, but they don't understand that can impact everything too. And what about debt that buyers forgot about? Maybe it's unpaid medical debt. Maybe it's, one of my favorites, student loans that they haven't been paying on, and then they're going to buy a home.
So normally we have to look at the last 1 or 2 months bank statement. So on there might show up a $500 payment for something that doesn't show. Maybe your aunt has a car that you're paying her for. So yes, all the debts, it's not just what's on the credit report, could also show up on bank statements. As far as student loans, most of the loans are sold either to Fannie Mae or Freddie Mac, and they have different guidelines as far as what they consider a minimum payment to be. So what I always say is the best thing to do is maybe not run your full credit report. There's some sites out there where I can help you get into and see what's on your credit report, just so that, you might think that you have perfect credit, and all of a sudden there's a mortgage late that showed up 2 months ago that you were not aware of because you have automatic payments. So first thing to do is try to work on the credit. What you were saying about student loans, the problem with student loans and any federal loan is if you're trying to get an FHA loan or a VA loan, they run something called CAVERS, and it checks to see if you're delinquent or defaulted or late on any federal obligations. It could be your federal tax returns. It could be a student loan, a VA benefit. So it's depending on the type of loan that you're getting, it's important to do a deep dive.
Tell us what does CAVERS stand for?
Honestly, I don't know.
Well, it's actually, and I wanted to clarify this for our viewers, it's the Credit Alert Verification Reporting System. And that's a federal database, right, that FHA and VA use so they can confirm all of what you just talked about.
And it's used on FHA and VA financing because those are government-backed loans.
Well, that's always something people need a reminder of, I think, especially if, they've had loans 10 years ago or 15 years ago. And I've seen where people, this comes up during the loan application and they're like, oh my God, I forgot all about that.
All right, so let's transition a little bit. What about changing jobs or income structure, mid-process? What are the challenges there?
I think someone might be 1099 and then they switch over to salaried. We need to make sure that there's no gaps in employment. They do look at a 24-month history and make sure that there's no differences in no gaps in more than 30 days. I've had customers. I just had a customer that I did a loan for, and when we went to do the refinance, she's now working at another company that is paying her a lower salary with a bigger bonus. The problem is that the bonus does not have a 2-year history, so the guidelines, the rules are different. We were able to work some ways around that. Also had another customer that was supposed to close, let's say, on the 15th of this month, and they were going back and forth with the seller on some repairs. And what a lot of customers don't realize is that up front we get a verification of employment or their pay stubs and W-2, but at the end, every loan is required to have a 10 days before signing loan documents, we're supposed to get a verification of continued employment, that you're still working there. They don't check income. They just need to make sure that you're still working there. That can sometimes be difficult with some union jobs and larger companies where we're trying to verify it. But I had a customer that was supposed to close around the middle of the month, went back and forth with the seller, and now we were getting close to the end of the month to sign, and they were part of a layoff package. So that loan did not close because we did not close on time. So it's important that everyone be transparent with us as far as income and job changes and everything like that.
So don't make any changes to your employment status if you can avoid it. Obviously, if you're laid off, you probably didn't see that coming.
Close quickly.
Yeah, or if you know that your job might be on the line, maybe it's not a good idea to embark on this process in the first place until you have a better idea of what that situation is.
Very true.
All of that to say, what steps can buyers take to keep their loan reckoning free?
The loan application is the most important part, just making sure that everything on there is correct. There's questions on there about, do you owe alimony or child support? I have a loan right now where the customer is actually receiving child support, and it showed up on the credit report as an obligation instead of income. So we had to get the documentation. The application gives us an idea of their income, their assets, and anything else that could come up. So filling out the application as timely as possible. I've had a couple customers that they're just looking. They've been looking for 6 months for the house, and all of a sudden they find the perfect house that they want, and they're scrambling. And there's things that they have not addressed ahead of time that they could. For example, if you have a late on your mortgage or your credit card, and we would have run the credit a month ago, we would know about it and we'd have time to dispute it and hopefully get it removed. But yes, just being completely pre-qualified, credit, income, and down is so important in the shopping process. And the earlier you can start, the better.
Yeah, the number one complaint I hear a lot from lenders is, they're waiting and they're waiting, to get what is needed. And, the consumer's going, well, why do they need that? And I think the consumer sometimes shifts from, right, the lender is on your side, which you are on their team. You're trying to help them get across the finish line. But then all of a sudden the lender becomes their foe, because it's like, they don't need to know that. Why do they, I'll get that to them when I determine, I want to get that to them, but not, before.
It's like pulling teeth. Sometimes they feel that it's personal confidential information, and they'll share things with us that they won't share with the realtor, which is fine. But it's important to know things ahead of time instead of trying to hide it from us. Because like I said before, once an underwriter sees it or suspects it, you can't take it back.
And, sometimes they delay making the full loan application with you because they could be shopping around for rates. And, one of the cardinal sins, I feel like, once you've opened escrow is, we've negotiated in good faith with the seller. We've presented a pre-approval letter with lender A and proof of funds. And now that buyer, escrow's open and, we're getting into inspections and all these other things. And they're not getting the lender what they need because they're shopping rates, because they still want to just make sure nobody else, has a better rate. And that can cause a contagion effect with the contract timelines and a domino effect. And as Mr. PhD here knows very well, he's got a great counter offer template for managing this exact thing that happens in a transaction.
Yeah, I put in every counter offer that basically you can't change horses in the middle of the race without the seller's approval. What I mean by that is you filled out a purchase agreement with a particular lender with their information, and you have the interest rate and all the general information in the contract. This is who you're going with. If you're going to change lenders in the middle of the contract, you need to notify us so that we can get approval from the seller, because it changes all the conditions from the original offer, counter offer. And a lot of agents don't understand that when you change that, you have now changed conditions. So I make sure that it's in a counter offer that can't change horses in the middle of the race.
Well,
and the buyer's jeopardizing, these huge deposits. I mean, typically in Orange County, it's 3% of the offer price. So there's a lot to lose here. There's a lot on the line.
And the other thing too is that most of these loans don't have prepayment penalties. So you could always refinance in a couple months if rates come down when it's at your leisure and your schedule. But in the middle of a purchase, you have so many people dependent on it. You have the seller making plans to close on the 15th. And if you don't close until the 30th, that could create a domino effect on the transaction that they're buying and that person selling their house. It's the cheapest is not always the best. I've been doing this a long time, and just common sense says that if someone has the lowest price, they're also going to have the longest line. And we've closed transactions in 2-3 weeks, and some other places might take 2 or 3 months, just because obviously if they have
this, it's frustrating. I've been in this business over 20 years, and you made the statement earlier that the buyers, the borrowers, they will give the lender in a lot of cases more information than they give the agent. We're going to find out anyway, because we're going to be talking to the lender. And it's frustrating because they'll give all their information to their financial advisor, their CPA, their attorney. But when it comes to buying a house, they're tight to the vest with the agent, which again, we're going to find out from the lender. They're either approved, not approved, what the situations are. If there's a hiccup in the loan process, the loan officer is going to call us and tell you, hey, by the way, this is happening. I've called the buyer. I want to let you know what's happening. Because if I'm a buyer's agent, I've got to communicate that with the listing agent, which has to tell the seller, because we're all tied together. So for all you buyers out there, just tell us up front.
Surprise is never a good thing in real estate.
I just had a transaction where it was sensitive that the transaction closed as quickly as possible. And the buyers, first-time buyers, they were hesitant to sign the initial disclosures. And I just mentioned, the initial disclosure is just items that we're required to give out. Federal law requires us to give it out. It doesn't commit you to anything. There's no skin in the game. Really, the first time that you put any money into it is when we do a home inspection or an appraisal. So let's get the loan in. Finally got the loan turned in on a Tuesday and got approved 2 days later. But the seller was on me, what's going on? Are we approved? Are we not? We can't move forward until we get the initial disclosures and all the income asset documentation to submit a clean file to underwriting.
So would you say it's a good idea for the buyers? I know they're shopping for a house. They're doing the pre-qualification in a sense. Would you say it's best to have that package pretty well ready to go, even though it takes some time maybe to find the right property? So if they have it kind of ready to go with you today, but they don't find a property for another 30 days, but the package is pretty well put together today, how difficult is it to update the package so they can make a good bona fide offer?
Good listing agents, and I've had listing agents that'll call and they'll interview me. How quickly can you close? Where's this loan going through? Has the customer been pre-qualified or pre-approved? On a pre-qual, a lot of times it's, hey, I'm going to have Bob call you. Can you just send me a pre-approval letter? We can't send a pre-approval letter until we've checked their credit, their income, done a deep dive, because we don't want any surprises. We don't want that student loan that they forgot to tell us about, or there's a lot of things that child support, there's a lot of things that come up that they forget to tell us because they don't think it's important. But it whether you think it matters or not, assume it does matter. It's important.
Yeah, I mean, that goes to communicate everything. Like we talked about, there's a lot of, I forgot, especially like the child support or student loans. I mean, yeah, if you're not sure it matters, assume it does, because that's going to come back and blow up the transaction, 2 weeks before closing, and then everybody's mad. It makes the lender look bad. It makes the buyer's agent look bad. And, everybody's upset about this situation that, the only person that was in control of that information and what could happen about it is that buyer.
And it creates stress, unnecessary stress. Like I said, my job is to have it close as smoothly as possible, because then the customer will come back and use me again for a refinance. There's no reason to make it stressful or a one-time transaction. It's important to have that relationship with the agents and with the lender.
So you just want to be as proactive as possible. Keep everything status quo.
Yes.
Try not to change jobs. Try not to get laid off if you can. Don't go out and do the 0% interest at the tire shop. Consult with your agent. Consult with a good mortgage advisor. Get them on your side early before you even go out and start shopping for a home, because there's a strategy, and you've got to get the strategy right to play the game, because this is a very stressful game and there's a lot of risk and expense associated with it.
And don't buy a car.
Not to interrupt, but what's interesting is, we're in a time now where it takes longer to sell a house. There's a lot more choices. Buyers have more choices. They have more time. If you went back a few years when we were basically in COVID, just, post-COVID, things were selling in hours. You don't have that kind of time. So now you have a little bit of time. So it goes back to what I said, do the application, everything up front today. You're continuing to look for a property. When you find that dream house in 2 weeks, you can call your lender and say, what do I need to do to update my file? Because I want to make an offer on this property today. And then you can guide them appropriately.
And I can speak with the listing agent and be confident that I can get. Normally, when you turn in a contract, you have so many days to remove loan contingency, so many days to remove appraisal contingency, so many days to close. I'm not going to tell someone to order an appraisal or to remove their loan contingencies until the loan is approved and there's there's what I feel like a pretty solid loan. The sooner I can do that, it all goes back to having the income documentation up front, being transparent, and the sooner I can get full loan approval, the sooner you can go back to your day-to-day job.
So what you're saying is to avoid a reckoning, sign all the required disclosures and documents in a timely fashion.
And work with a professional that will return your calls, agents and loan officers, and has the experience to anticipate what could go wrong ahead of time and hopefully avoid it.
And I'd say preferably they're available. They work like we do. You're available 7 days a week.
Yes.
I can reach you on your cell phone. I've called you at, odd times, Saturday at 7:00 because buyers went to see something and oh my gosh, now they want to make an offer. That's not going to happen if you're calling 1-800-LENDER extension 12345 and oh yeah, you got to leave a voicemail and they're not available on the weekends. And, people need guidance. Usually these things happen after hours, after, these companies are closed or weekends or bank holidays. And, there's only so much we can do and, advise them. I can crunch payment scenarios all day long, but I'm not a lender. I don't know their credit and assets and all the things that you need to know in order to advise them precisely on what they're looking at payment-wise.
A lot of lenders will also run it like an assembly line where they'll have one person take the application, the next person ask for documentation, next person do something else, next person do something else. When you have that many people involved, there's no way they can keep the story straight, and you find yourself repeating the story over and over. The call centers, it's you don't do that with medical or a lot of other things. It's better just to keep everything with one person, and sometimes a team is hard to communicate with.
I know, Cara, you had a situation recently with a client that was using a credit union. Monday through Friday, 8 to 5. Can't reach him after 5 o'clock or on the weekends.
You got it. And I was crunching payments like no tomorrow using an app I have.
You're doing their job.
Yeah, again, I wasn't the lender, and ultimately they decided to go with an adjustable rate mortgage in a rising rate environment, to get the best rate. But that definitely had some challenges trying to get hold of people and felt a lot of stress and pressure to fit these, needs in between 8 and 5, and the client worked and couldn't always have access to, being able to get away from what they did. So yeah, people don't consider these things when they're, about time to get a mortgage because they just think you're all the same.
And, in Southern California, we're not getting mortgages for 100,000. We're getting mortgages for 700,000, $1 million, $2 million. It's big numbers. So we understand that, people work during the day. They wouldn't be buying a $2 million house if they weren't working in a lot of cases. But we need to be able to communicate, on a regular basis. And like Cara said, our job's not always 8 to 5. I know, Bob, your job's not always 8 to 5. You're doing stuff, around the dinner hour because that's when they get home and they need to discuss it. So let's talk a little bit about the, financial behaviors lenders monitor even after you're pre-approved.
So as I mentioned before, we do get credit alerts. So if we're in the middle of a transaction and you go out and you get a credit card or a car loan, it'll pop up. And then any credit inquiry in the last month or two, we have to address to make sure there's no new debt because it could take a month or two to show up. So yeah, just try to make sure you don't have too many inquiries. Too many inquiries will also drop your credit score. If there's any items that we want to dispute, we want to do that ahead of time. But the main thing is to avoid any surprises.
And let's talk about the bank account. Again, the lender is, they're kind of big brother hovering over you because they're the ones giving you the money to buy that house. So your bank account or accounts can now be subject to scrutiny. So talk about what kinds of things that, you as the lender look for when you're looking at all these bank accounts.
So the three main things I look at or that underwriting looks at is overdrafts. If you have overdrafts in your account, are you going to maybe not make the payment? Because they're looking at the character. The second part it comes up a lot is moving money around. Oh, I was moving money from here to here so I could do the wire. Try not to move any money around. Once the loan is approved, we can we can send the wire from one of the accounts that you have listed, but any large deposits, maybe more than 25 or 50% of what you make a month, needs to be sourced, because we need to make sure that you didn't go out and get a loan from a family member or from, some online place for the down payment. And now that's a debt that's not being reported on your credit report yet, and not being accounted for in your debt to income ratio. So try not to move money around. We're looking for clean, predictable accounts, stable. And sometimes that means I'll just get the savings account. Why introduce a checking account if it's not needed? So part of it is also how I package and prepare the file for the customer.
That's really where the coaching comes in, because I've seen where people, say, okay, I'm going to do the deposit from this account, but all these other things I'm going to give to the lender. It's like, no, it's all connected. And if you're robbing Peter to pay Paul, that all has to be shown to the lender, right? Everything is a contagion effect, and it has to add up. So the bottom line here, to avoid a reckoning with your bank accounts, keep your accounts stable, predictable, clean. Don't, jam it up with any unpredictable big deposits or, withdrawals, and certainly not non-sufficient fund fees, because that's going to create, a little more difficulty.
Another part too is I'm sorry. Another part too is making sure that we have everything accounted for, because not only do you need the down payment, you also need money for closing costs. So having a good loan estimate up front and having a loan officer communicate with you how much money you need helps avoid the last minute scramble. I'm $5,000 short. I'm $2,000 short. So yes, transparency, loan estimates. We send out loan estimates and closing disclosures so that there's no surprises at the end.
Yeah, and you work with escrow on that too, where they, give you the escrow fees and the title fees and so forth, so that you can, marry the two estimates together, so that you can communicate with the customer. So we may have touched on this a little bit earlier, I'm not sure, but what about employment stability? I'm in the middle of getting a loan and I've got a job, and then oopsie, something happens.
I've seen someone that went from a salary position in a company to a commission position. It's if possible, try to avoid any changes and don't get laid off. The bonuses seem to be a big thing. There's just so much that can happen with employment. It's important to.
So if I get laid off, I need to call you.
Yes, please.
All right, so let's recap. The three biggest loan killers: job changes, new debt, and unexplained deposits. The behaviors lenders monitor: credit, bank activity, and employment. And the steps to keep your loan safe: freeze your financial life when you're in the middle of a purchase of a property, keep your accounts predictable, communicate everything, protect your credit, and stay stable at work. Would you agree?
Completely.
So let's talk about some alternative financing options, because there's the traditional, right? The Fannie Mae, Freddie Mac, but not everybody fits in those boxes necessarily, especially people that are self-employed, entrepreneurs. Maybe there's, income from some other sources, not just a regular paycheck. So let's talk about the non-QM loan space. What is a non-QM loan? What does that stand for, and who's it for?
So I used to work at Home Savings and Countrywide back in the day when they used to have what's called a liar's loan. In order to qualify for this loan, you need to make $6,000 a month. How much money do you make? Oh yeah, I make $6,000 a month. Okay, as a cashier at McDonald's, let me put that down. After the crash in 2006, 2007, we are required to make sure that you have it's called ATR, the ability to repay. We're by law required to show that you have the ability to repay. And those are called qualified mortgages. Those are the Fannie Mae, Freddie Mac, FHA, VA, the traditional loans. We can only use certain credit. We can only use certain income. We can only use certain assets. We have non-qualified mortgages. Those could be things like interest-only loans, where you're just making the minimum payment of interest only. The most common ones are bank statement loans, where instead of using your pay stubs and W-2, we use the last 12 months of geared towards self-employed people, obviously. We use the last 12 months of your deposit, and then depending on the industry that you're in, we give you credit for 50 to 90% of that as your income. The next step up would be like a 1099 or a profit and loss loan, where we use your the profit and loss. You could be employed for 1 year with the profit and loss loan. And then we have the nuclear option, which is the no income, no asset type loan. Another thing that's real popular with rentals is something called DSCR, the debt service cash flow loan. The idea behind that is, if let's say you own 10 other properties and you have a business that makes $10 million a year and reports a loss every year, the DSCR loan looks at cash flow. If the place rents for $6,000 a month, the maximum debt is supposed to be $6,000 a month. As long as that rental cash flows, they don't look at any other income documentation or debts. We even have some programs that'll go down to 0.75. So, for example, it rents for $5,000 and your payment's $6,000. And we even have a couple that are no ratio DSCRs. And the rates aren't that bad. I just did a no ratio DSCR, and it was only about 1% higher than it would be for an owner occupied. And it was honestly pretty similar to what a full doc non-owner would be. They have different guidelines as far as loan amount or loan to value, but there is definitely a lot of different loans besides what the traditional loans that the banks have. Or it could be tailored to the customer. And then inside of those, like today I was working on one, customers retired, they have large assets, and we are doing a asset depletion loan. Let's say they have $5 million in the bank. On a traditional loan, they would take the $5 million divided by 30 years. That would be your income. There's some lenders that will take that and divide it by 5 years or 7 years. So there's a lot of different types of loans out there, depending on the customer's needs, and they're not priced that much higher.
And so what are the potential reckonings with these kinds of loans? I know I've run into them with people. Is it higher interest rates? Is it more down payment? What are sort of the gotchas or the hitches people need to be aware of?
They're considered higher risk loans. So the rate might be a little higher. They usually have a prepayment penalty. Prepayment penalty means that if you pay it off in the first 1, 2, 3, 4, 5 years, there might be a penalty of 5%, or so there's prepayment penalties on some of these. If anything, I'd probably recommend no more than a 1-year prepayment penalty. But the down payment or the loan amount might be reduced. Like I said, this morning I had a scenario. I ran it by 5 different investors, talked to the account executive, and found the 2 that I thought were the best for the customer. And not all non-QM loans are the same. Not all investors have the same guidelines. It's their fund, so there's more flexibility with some investors.
And does the time to close on these loans differ than the traditional Fannie Freddie?
They could take a little longer because they're usually smaller operations. For example, United Wholesale, which is a company that we work with the most, they are known for getting loan docs out in 2 weeks. Some of these other ones might take 4 weeks, 3 or 4 weeks. So it's important when, and for you guys, I'm sure the listing agent or the buyer's agent, it drives them nuts when someone comes in saying they're getting a full doc loan and then they switch to an FHA VA or a non-QM type loan, because it means that we're not going to be able to meet the closing date. We try to analyze as quickly as possible, put it with the right lender. And like I said before, it's more important to close on time. If you want to refinance in a few months when it's on your schedule, go ahead. But with a purchase, there's so many parties involved that you don't want to create that domino effect.
And speaking of, not closing on time, let's talk about another reckoning that can derail your mortgage, and that's a property reckoning, right? Because not only do you have to qualify as the borrower, but then the property has to qualify as well. Sometimes the two do not mix. Sometimes, agents don't give half a thought to this when they're showing buyers properties, or even the listing agents listing these properties. It's like, wait, stop, the fence is here. This property cannot go traditional Fannie Mae, Freddie Mac. So let's talk about, what types of property situations and conditions could cause a property not to be financeable with the traditional, path. What kinds of things could that be?
So I would say FHA and VA are definitely the strictest on the condition of the property. Obviously, we have to check that the utilities are on. They have to take a picture of the water flowing in the kitchen. There can't be any repairs in the bathroom. I've had purchases and refinances where the bathroom is torn apart, and we can't do that on a traditional loan. So that there has to be no health and safety issues. On the other end of the spectrum, I have one right now where we're ready to close, and the customer, the buyer, decided that they want a new roof and a new air conditioner. So we're trying to figure out how to make that work. Luckily, the appraisal came in high enough where it should be able to work. But the condition of the property, it has to be habitable, and some loans are tougher than others on it. It's
Like, for example, empty pool shells.
Oh, yeah.
What about unpermitted structures, or, like a back house that is being marketed as, an ADU, but it's really not an ADU. There's no permit history. I had a property where we had a back house in Eastside Costa Mesa. We did not even count the square footage. We disclaimed it because there were no permits on file. The buyer was getting a traditional loan on this property. And the appraiser came in and they flagged peeling paint on the outside. I mean, this thing was from the 50s. And then there was some peeling paint on the ceiling in a bathroom, and that was a condition that had to get fixed. The underwriter sees this appraisal and they're like, wait a minute, we want to see permits on this back house structure. There were none. And so that triggered a reckoning, because then the buyer had to flip over from conventional to non-QM, and that meant a higher interest rate. It was right before the election in 2024, and they didn't want to lock in their rate because they wanted to see what happened after the election. So you talk about nail biting. Nobody really had planned for this, and the appraiser had to go back out and check it. We had to make some of these just sort of lipstick on a pig repairs, if you will. I mean, they were going to tear the whole back house down along with some other substantial stuff. So yeah, I mean, these are the things you have to think through, even as an agent, when you're working with a buyer, you're listing a property, so you can attract the right buyer audience and that they're getting the right lender to help them through that purchase.
The health and safety is definitely important. The other thing that comes up a lot is the solar panels. What's going to happen with the solar panels after the closing? If they're leased or financed, if they're being leased, then we have to include that debt in their ratios. The other thing that the other thing that comes up sometimes is how quickly they want to close.
So bottom line,
solar. Just one thing on the solar. That's another point that I do put into my counter offers. So if I'm representing a seller and they have solar on the property, I have language that goes into the counter offer that goes back to the buyer's agent, that you have to qualify for the debt to income ratio for this solar panel of $100 a month or $125 a month, whatever it might be. And when they sign the counteroffer and agree to that's a condition of sale, which the lender gets a copy of the contract and the counteroffer. So it's very
and the solar panels, they usually have a UCC filing, and that could take a month for them to respond to either a payoff or subordination where they agree to. So it's important with the solar panel for escrow to get started right away. Another thing that is coming up a lot, I think you had something come up with this, Cara, is the condos with the balconies, the new California law that just passed about inspections. And
yeah, I mean, there's all sorts of gotchas out there. So again, just, being proactive, getting into the weeds of whatever it is you're working with, getting the lender looped in so that you don't go down a road that's not going to have a happy ending. Certainly, the pool shell, that's a big one, right? That's a health and safety issue. And, the appraiser is the eyes and ears of the bank. So they're going to see these things. They're going to take pictures of it. The underwriter is going to get this appraisal. It's going to start triggering all sorts of questions and looking into things. And, we're going to get, off track with what we were trying to do.
It could even be as simple as the water heater not being double strapped. There's a checklist of items, and that's why it's so important to have professional listing agents and buyer's agents that know what's going to happen ahead of time, so it doesn't slow down the transaction.
Smoke detectors, CO2 detectors. Yep. Yeah, those are big ones that can hold things up at the last minute. And I've seen, listing agents running their listing with Velcro, slapping them on the back of these things, putting them up on the wall so the appraiser can come back, and take pictures of it for the bank to say, yes, it is here. Well, Robert, this has been jam-packed with helpful tips. If you're watching this and you remember only one thing, it's this: your loan is not safe until you close.
It's not done until it's done.
So thanks so much for joining us today.
Thank you.
Thank you.
Thanks for tuning in to The Real Estate Reckoning. Make sure you're subscribed and share this episode with someone who needs to hear the truth about buying and selling real estate. We will be back with more reckonings soon.